when we look on the taxation of extraction companies and petroleum companies, we say that the taxable income shall be the difference between the value of production or at arm's length and the cost of production. So that is the only thing that we have to be discussing right now. Taxation of extraction and petroleum companies.
Excuse me, Malim.
Extraction and petroleum companies. And we have said to get the taxation of extraction and petroleum, we are going to be looking on the difference between, the value of production, at arm's length, the value of production at arm's length, and the cost of production. So there are some of the key things that you need to be checking on, the points to note. Number one, we are looking, what is this value of production? And the value of production, we are saying, it is the total amount available from the proceeds of exploration, or these are the amounts receivable.
Excuse me, Malim.
Yes.
Are you writing? I can't see your board.
Yes, I'm writing.
I can't see your board.
No problem. Good. So we are looking on the value of production. These are the amounts receivable from the proceeds. Of exploration. From the proceeds of exploration and petroleum companies. Number two, we normally look on the prices at arm's length. What is this price at arm's length? The price at arm's length, we are saying that it is the price that is not influenced by any commercial undertakings or relationships other than the ones stipulated in the contract. So when you look on the arm's length, we are saying that these prices does not relate to transactions between related parties. For example, like a branch or head office, parent and subsidiary companies. It does not relate to that. Number two, we don't look on two companies with some relationship in terms of the management. So the arm's length we have just said is that it is just a price that is not influenced by any commercial undertakings within the contract of extraction and petroleum companies. The third thing that we have to be checking on, it is the petroleum contract. Petroleum contracts. And when you look at the petroleum contract, it's just an agreement. It's just an agreement between the government and the petroleum companies and the petroleum companies. Right? So there is an agreement between the government and the petroleum company to carry some services under the Petroleum Act. Number four, we normally talk about intangible drilling costs. Intangible drilling costs. These are the terms you will see in our questions. And we are saying that these are pre-production. They are pre-production expenses. Incurred by the petroleum companies, whether capital revenue in nature. For example, when you're looking on the intangible drilling costs, we are going to be looking on the cost of discovery of petroleum products, winning access, license fees, drilling of wells, acquisition of drilling machineries, construction of structures at the site. But what you need to understand is that all these costs are allowable. These costs are allowable in full. They are allowable in full. Number 5, we normally check on qualifying expenditures. Qualifying expenditures. And when you look on the qualifying expenditures, these are capital expenditures incurred during production process. For example, we have to be checking on the costs of purchase of assets. For example, we can talk about purchase of motor vehicles. We can buy motor vehicles there. Generator, furniture and fittings. Furniture and fittings, etc., among others. The other thing that you need to understand that they qualify for capital allowance. They qualify for capital allowances. They qualify for capital allowances at the rate of 20% per annum. 20% per annum on a straight line basis. On a straight line basis, but I will be able to confirm whether they have been able to revise that rate during the 2020 review. Then number 6, we have mobilization. Mobilization and demobilization. Mobilization and demobilization, these are things that we have already discussed there before. And we know very well that these are just the cost of hiring expatriates and bringing them in Kenya. And we know the purpose is to serve us alone. We serve them alone. And we know very well that with their equipment, and that is mobilization, bringing them in Kenya and purposely to serve us alone. But the mobilization is taking them back to their country, original countries. So we are saying that it does not include the cost of movement within Kenya while on service. The other thing that you need to be looking on is petroleum service subcontractors. That is number 7. Petroleum subcontractors. Petroleum subcontractors. And when you look on this service, it just there's a body corporate that is hired from outside Kenya, that is, I believe, by the petroleum companies to offer some specialized services. So the subcontractor is considered to have to be an non-resident, hence it is normally taxed at a corporation tax rate of that 7%, that 7.5%, because we assume is a non-resident. We normally assume it's a non-resident, and therefore tax at the rate of that 7.5%. And we are saying the taxable income of a subcontractor is assumed to be 15% of the subcontractor's fees paid. Now, in that case, we say the tax on this income is charged as a withholding tax and submitted by the Petroleum Companies Act by 20th of the following month, together with the returns, being able to indicate subcontractors' fees paid, tax liability, any form of reimbursement made to the subcontractor, and the mobilization and demobilization cost paid. Now, in this case, I just want us to look on May 2018 question, because most probably we just need more questions than theories. So we can look on May 2018 question 2A to see how these questions are basically done. How can we be able to do these questions? So let me check here the question. So we are talking on May 2018. So you can read the question, please.
Okay. Mafuta International Limited, a petroleum exploration company, provided the following financial information for the year ended at 1st December 2017. We have crude oil exported. We have crude oil sold locally for further refining, exploration costs, incidental income from petroleum operations, management and administration expenses, depreciation, provision for bad debts, that's specific debts, non-productive rent. The schedule of qualifying capital expenditure was provided as follows. We have capital expenditure item, we have date of acquisition, location and amount. Under the capital expenditure item, we have plant and machinery. Acquisition date was July 2015. The location was offshore, and we have the amount. Fixtures and fittings, July 2015, onshore. Building, February 2016, onshore. Pipeline and storage tank, February 2017, offshore. Additional information. Number 1, the international market price of crude oil during the year was $12 US per barrel. The average exchange rate of the US dollar to the shilling was 1 shilling or $1 US to 105. The crude oil sold locally was disposed of at 35 shillings per barrel. Required tax liability fund for Mafuta International Limited for the year ended at 1st December 2017.
Very good. Now, when you look on this, we are looking on tax liability or refund for petroleum company, and you can see the examiner has already given you the asset there, which you are supposed to be calculating the capital allowances. We have already been discussing about taxation, and what you have to be checking is how we tax these assets under the new taxation reviews which have been made. Now, in this case, I will request you to share the link to the students who are asking there. You can share with them. Now, we have talked about, we are talking about, examiner has already given you the sales, because our sales in this case, because to get the tax payable, the taxable income, we have to be taking the value of production at arm's length. Then we subtract the costs. Now, in this scenario, when I look on the tax in which we the revenue which we collected, we have the crude oil which we were able to export. We were able to export 1.4 million barrels, and the crude oil which was able to be which was sold locally, we sold 750,000 barrels. So in this case, we have to be looking on the gross income, which is going to be generated from the exportation and selling the crude oil locally. From there, we have to be checking on the allowable expenses, and the allowable expenses are going to be, we are going to be checking from the costs that are allowable as per the Tax Act. And now from there, we have to be looking on the computation of the tax liability. Now, let us go to our board. Let's go back to our board here. And in this case, I just wanted us to look on this question. So the examiner is giving us so already we have been given assignment here to do. So we start with Mafuta International Limited. Right? So you have been told to compute the taxable income. You start with 2015 taxable income computation. Taxable income computation. So let us just have 2 columns here for Kenya shillings. Another one here. So we start with the crude oil exported. And I know very well that we were able to export 1,400. Let me reduce my shillings to thousands. So examiner was able to give you the exchange rates there for this crude oil. Now, for example, I can see note number 1, additional information. The examiner says the international market price of crude oil during the year was US dollar 12 per barrel. So the average exchange rate of the US dollar to the shilling is 1 is equals to. So when I look at it, the examiner is just saying 1 US dollar is equals to, is it 105? The examiner is talking about 105. Now remember, one barrel was costing us we were able to receive 12 US dollars. So once you convert to Kenya shilling, is how much? So I just come here and say, let me multiply with 12, I multiply by 105. Multiply by 12, I multiply there with 105. Right? So how much it is? So 1,400 times 12 times 105, we are getting 1764,000. 1764,000. Then you add crude oil, which is sold locally. The crude oil which we are selling locally. How much are we selling? The examiner has already given us is 750. So additional information number 2, we are being told the crude oil sold locally was disposed of at 5 shillings per barrel. So we multiply by that 5. So 750 times 35, I'm able to get 26,250. So how much is the total? Plus 1764,000. This is 1790. 1790. 250. Remember, this is your gross income. Now, I just want us to list the allowable expenses. We are done with the additional information. So let us list allowable expenses, and we start with the exploration cost because we have already dealt with the incomes. So the exploration cost given there is the first expense for us. Exploration cost amounting to 16,000. The other thing that I can see here, the other thing which I can be able to see, it is that the examiner was able to tell us there is an incidental income from petroleum operations, right? Which I did not factor somewhere here. So let me just include here, incidental income of 1,250. Incidental income of 1,250. So I just take 1,790, 250 plus 1,250. Getting 1,791, 500. That should be our gross income. 1,791, 500. Let us continue. Now, after that, we have management and administration expenses. Management and admin expenses. So these amounts to management and admin expense amount to 14,000. The other one, I can see there, we have depreciation, which we know very well is a disallowable expense. Provision for bad debts, we have already been told, our specific bad debt is 1,250, which is allowable. So we talk about the specific bad debts, which we are being given as 1,250, right? Then from there, we proceed to non-productive rent, right? Non-productive rent, which is allowable. We have non-productive rent, which amounts to, our non-productive rent is amounting to 1,156. And this, you can even do an assumption that it relates to admin, because it means the rent that is not going to be yielding any return. Now from there, let us compute our capital allowances. Capital allowances. Capital allowances. So in this case, when I check on them, we are being given for the date of acquisition. The schedule of qualify for capital expenditure was at that amount. But in this case, under the new review, I can be able to confirm that I have said we are going to be confirming under the new review whether they were able to review the taxes. But recently, or in meantime, let us do with the 20%, which is in our notes, but I will clarify the rates. So plant machinery, for this instance, we have 6,000 multiplied by 20%, which is 20% as per the Petroleum Act. So 0.2 times 6,000, getting 1,200. Now, the other one will be fixtures and fittings. Fixtures and fittings amounting to 2,000 times 20%, coming to 4,000. Is it 4,000 or 400? Let me check. $400. Then we have buildings. We have buildings there, which are qualifying. So it's 20%. We multiply by the cost of that building. You can see is 4,000, getting 800. Then we have, right? We have pipeline and storage, which we purchased during the year. Pipeline and storage. Pipeline and storage. And in this case, we know very well that it was purchased on February 2017. So we stayed with it for 11 months. We multiply by 20% times the cost of this pipeline, which is 4,000. So in this case, we are getting 11 divided by 12 times 0.2 times 4,000, getting 733. So what is the total now for my allowable expenses, right? For allowable expenses. So in this case, I just take 16,000 plus 14,000 plus 1,250 plus 1,156 plus 1,200 plus 1,200 another one plus 733. We are getting 35, 539. Right? So get your total taxable income. Total taxable income. So I just take 1,791, 500 minus my answer. We are getting a total taxable income of 1,755, 961. 1,755, 961. That is the total taxable income. And I can see the examiner is asking you to compute the tax liability, right? So to calculate the tax liability, you just tax it just like any other company. So tax liability, I just need to take 30% of my total taxable income, 1,755, 961. So how much it is? Times 0.3, getting 526 Kenya shillings. We are getting 526,788. That is the total tax in which that organization should pay. That is the total tax they are supposed to be paying. I just wanted to do another question for petroleum. Question which was tested the other day. Let me look for the period. Okay, April 2022. We have a good question there. April 2022. We have another question there for petroleum. April 2022, question 3C. Tabitha, you can read for us. Tabitha, go on. Maureen, can you read?
Yes, I can.
Go on.
Scroll down a bit. Okay. Petrol Limited is a company in the business of exploration and production of oil and gas in your country. The company reported a petroleum profit of 143,600,000 in the year ended that 1st December 2021. This figure excludes crude oil produced but not sold, valued at 4.2 million. The following expenses comprising capital and revenue expenditures were deducted in arriving at the reported profit. 1, we have geophysical staff salaries. We have legal costs for title deeds, dry hold contributions, breeding and test development costs, capital losses from previous years, memorandum of understanding credit, royalties on domestic sales, royalties on export sales, and productive rent, customs duty on plant and equipment, purchase of assets for offshore operations, provision for restoration of wells, petroleum investments allowance. Additional information. Scroll a bit, Mwalimu. Additional information number 1, petroleum investment allowance included depreciation of equipment of 378,200. Offshore operations included a tractor purchase at 920,000 for use on site in your country. Computers and computer softwares was for 708,000 and 360,000 respectively for use in the country of sale. The offices were partitioned at a cost of 1.48 required. A statement of computation of petroleum profit or loss for the accounting period ended that 1st December 2021. 2, tax payable, if any, by the company.
Thank you. So I can see here the examiner wants us to do the question in similar way we have already been doing other questions, because already we have been given to come up with a statement of computation of petroleum profit or loss for the accounting period ending 31st December 2021. Now, in this case, when I look at the question, we have to be looking on whether the examiner was able to give us a figure for the reported profits. Now, at the point where the question started, I can see that the company reported a petroleum profit of 143,600,000 in the year ended at 1st December 2021. This figure excludes crude oil produced but not sold, valued at 4.2 million. Now, we have been told that the following expenses comprise capital and revenue expenditures were deducted in arriving at the reported profits. So we are going to be just doing our adjustments as normal, the normal way we normally do. So we have geophysical staff salaries. We know that is allowable expense. We have the legal cost for title deeds. Remember, you are dealing with explorations. We have to be checking on whether the land that we want to explore, is it allowable, disallowable, and you find the legal cost for the title deeds is that disallowable expense. Dry hole contribution is allowable. Drilling and test development costs, we know it is an allowable expense. Capital losses from the previous year, right? We know they are disallowable expenses. Memorandum of understanding, allowable. Royalties on domestic sales, disallowable. We know royalties on export sales, they are allowable. We have non-productive rent. You saw on the other side it was allowable. Custom duty on plant and equipment. We don't use another type of tax in the computation of another type of taxation. So it is a disallowable expense. Purchase of assets for offshore operations. You know it is allowable. Provisions, we say it should be disallowable. We can't be having two provisions. And then we have petroleum investment allowance that I can see we are being given down there. Now, the other thing is the additional information given there by the examiner. And I can see petroleum investment allowance, which included the depreciation, which we know very well is a disallowable expense. We are being told the offshore operations included a tractor purchased at 920,000 for use on site in your country. So we are going to be looking on giving tractor capital allowances. Now, the other thing that we have to be checking on is that computers and computer softwares was for 780,000 and 360,000 respectively for use in the country offices. And the office was partitioned at 1480. You know very well that all those will be given capital allowances. I'm very aware to clarify that the capital allowances for these assets should be the same, by the way. Like the other question where we have done with 20, when you're going to be doing your revision, just try to do it 25%. It should be the same. Due to the current review, I can confirm that. The required statement of computation of petroleum profit or loss for the accounting period ended at 1st December 2021. I'm clarified because when I checked on the previous period before the review, review in 2022, you used to find that the petroleum assets are basically they are basically taxed differently as when they are being included in other ways of computation. Now that is how now the taxman was able to reduce that burden of cramming 37.5 together with 20%. Now we are discussing about the same rates. So for example, if it's a tractor, it will be qualified for class 1 and at the rate of 25%. Computers, you know very well that class 1 at the rate of 25%. Computer softwares, the same, class 1, you know very well, and then the office partition will be qualifying for class 2 at the rate of 10%. You know, those are the two things in which I was able to clarify. But now, from there moving forward, at least now you know where the assets and how they are normally taxed under the Petroleum Act. Now, let me go to looking on the Petro question, because I see it's Petro Limited. So I will be able to start with, let me go back to my board. Let me go back to my board here. So it should be Petro. It is not Petro. It is earlier indicated there. So we have two columns of Kenya shillings looking like this, right? So I start with the reported profits. I start with the reported profit. Minimize your shillings to thousands. So here we are discussing about 143,600. Then we add back disallowable expenses. Let us add back disallowable expenses. When you are discussing about the disallowable expense, I've already indicated them for you. So let me start with additional information. And I can see we have depreciation, which is a disallowable expense. Right? So we start with depreciation. So the depreciation figure given there by examiner is 378.2. Now from there, after the depreciation, we can see there is an offshore operations and they are already included somewhere. Offshore operations amounting to 7840. Purchase of asset for offshore operations, they are disallowable expenses per note number 2. So we just need to deduct them. So offshore operations are disallowable expenses amounting to 7840. Now from the offshore operations, we go to note number 3, and we know very well that those basically qualify for capital allowances together with number 4. So let us go up there to the information provided. We start with physical staff salaries. I said it is allowable. We talked about the legal cost for the title deeds, disallowable expense. Legal cost for title deeds. For title deeds, this amounts to 562.4. Now from there, we proceed to dry hole contributions, allowable. Drilling and test development costs, allowable. We have capital losses, disallowable. Capital losses, they are disallowable. Now amounting to 192.8. 192.8. Now we move on to memorandum of understanding or on credit. That one I said is allowable expense. Now royalties on domestic sales, I said they are disallowable. The one that are allowable is for royalties on export sales. So royalties on domestic sales. Royalties on domestic sales amounting to 3.6. In our case, it's at 600. Now, from there, you proceed to non-productive rent. Already, I have shown you it is allowable expense. But we have the custom duty, disallowable. Custom duty, they are disallowable expenses amounting to 672.3. 672.3 million. Now, the other one, we have the provision. I think is the last thing under the computation there. Provision for, it should be the provision for restorations. Provision for restoration amounting to 1,575,000. We will be able to add those one and we put them on the other side. Now from there, we less. The only thing we can be able to deduct here, they are allowable expenses under the capital allowances. And I'm going to be starting with a tractor which qualified for class 1, 25%, right? 25%, you multiply by the cost of it, which is 920,000. So how much is that? 25%, 0.25. Times 920,000, which is 230, right? That is tractor. The other thing is computers. 25% class 1, you multiply by 25% computers were costing 780. It should be 230, right? 780. So it will be 0.25 times 780, which is 195. 195, those are computers. From there, we go to the computer software. Computer software. Another computer software, we have 0.25 times 360. 25% times 360. This amounts to 90. Then from there, we go to partitions. We go to partitions at the rate of 10%. 10%, we multiply by 1480, amounting to 148. So we don't have any other business there. 230 plus 195 plus 90 plus 148. Here we are getting 663. That is what we are going to be deducting there. On the upper side, we have 378.2 plus 78.40, right? Plus 562.4 plus 192.8 plus 3600 plus 672.3 plus 1575. This amounts to 14,820.7. So how much is the total taxable income? The total taxable income will be how much? So plus 143,600 minus 663. Here we are getting 157. 757.7. Now, tax liability, we are going to be taking, right, 30% or any otherwise stated. I don't know the revised to what. In our case here, it will remain the same. So let us work with 30%, right? 30%. We multiply by 157, multiply by 157, 757.7. So how much it is times 0.3, amounted to 47,327.31. That is how you work with this type of questions. That is how you have to be computing them. So that is well done. I will be able to share a question for revision, a solution for 2015, question 4, November. So this is an assignment, but I will share the solution for you to revise. November 2015, question 4C. This one I will share with you so that you can revise at your own time, Now, I just want us to shift our gears by looking on other types of taxation that we are yet to cover. Then we just need to be looking on the taxation of construction companies. I just want us to look on the taxation of construction companies. Taxation of construction companies there. And we'll move very quickly. Now, when you look on this taxation of construction companies, I said we shared some notes there with you, which are not part of the document that I shared with you for advanced taxation. So when you look on the taxation of construction businesses, we are looking on the a construction contract, which is just a job order contract, whose contract period may be extended beyond 1 year, and the income received may belong to many periods. So the taxable income is just determined the same way we normally determine for other companies, just like any other business. And that is why we are saying that the point that we are going to be noting here today, points to note. Points to note here, right? We start with the extra job, number 1. We start with extra job. And you know that this is the extra job. That is not, this is the extra job that that can be available. That can be available. The extra job that can be available outside the main contract. And I say, though, I will say that when you are constructing a road, you normally find, or when you see any construction of a road anywhere, you normally find that there are other areas within, when they are constructing the main road, they normally come up with a temporary road which is going to be used by the vehicles to access that certain area. So that is where we are talking about the extra jobs. And that is where we are saying, if the work is material, if we find that the extra job is more and requires a lot of other negotiations, that is where we are saying it can be considered as another contract separate from the original contract, and vice versa. Number two, we normally look on escalation clauses. Escalation clauses. Escalation clauses. And when you look on the escalation clauses, we are saying, we say that it is just a provision in the contract. This is going to be protecting the contractor. Protecting the contractor. It's going to be protecting the contractor. In case of failure, to protect the contractor in case of failure, to complete the contract, within the agreed periods, due to some circumstances that are beyond his control. So it is basically put in place to protect you, for example, from the natural calamities. Now, number three, we normally look on the value of work. Value of work certified. Value of work certified. Value of work certified, and we say it is just a percentage. It is just a percentage of the total value. It's just a percentage of the total value of the work that is approved. The work that is approved is the percentage of the total value of the work that is approved to have been completed during the year. Then number four in the last one, right? We talk about, we don't have the number four, but we can have NB on this scenario where we can say that in case of a construction contract, the taxable income shall be the difference between the value of the work certified during the year and the cost of work certified. Or the work certified during the year. So I've said in case of a construction contract, the taxable income shall be the difference between the value of the work certified and the cost of work certified during the year. So we don't have much to discuss about the taxation of construction businesses or companies, but these are the three main things in which we have to be checking on. So if you want to do your computation, just look on the value of the work certified and then compare it with the costs of the work that is being certified during the year. The cost of work that is being certified during the year. So let us do two questions here and we shift to another type of taxation. So we start with May 2016 question 5. May 2016 question 5B.
May 2016, question number 5B. Maureen, you can read.
Okay. Mjengo Limited is a real estate development company in the year ended that 1st December 2015. The company provided the following information. Number one, bought 100 acres at 6 million each for building low-cost houses in an approved development area. Number two, cost of surveying was 4.6 and conveyance fees amounted to 6.96. The cost of constructing each unit was 1450,000. The company constructed 240 units on a 20-acre piece of land. Next, all the units were sold at a price of 1.6 in the year 2015. Building materials for constructing each unit amounted to 740,400, inclusive of VAT at the rate of 16%. Professional fees paid to quantify surveyors, inclusive of VAT, was 417,600, and for civil engineers was 243,600. Drainage system and sewage line cost 960,000 for connecting all units built and to be built on 100 acres. The interest on loan to acquire the 100 acre was 7.8 million. Higher expenses for bulldozers used in the construction was 600,000 for each of 3 months used for the construction. Charges paid to the government in respect of approval of plans were 678,000. Cost of constructing a site office was 800,000. Higher cost for a saloon car for the site manager was 40,000 per month. A commercial building was also constructed at a cost of 5.6 million in a part of the land. The building was rented at a monthly rent of 480,000 with effect from 1st May 2015. The costs relating to the total 100 acres are to be apportioned according to the acreage used. Scroll up one. Required. The statement of adjustable taxable profit or loss from Mjengo Limited for the year ended that 1st December 2015. Number two, the tax payable by Mjengo Limited, if any, for the year ended that 1st December 2015.
So remember, the question is coming from construction companies. And when I look on the question, I will be able to check on whether I can be able to differentiate the question in terms of the acreage used, because we have to be checking on the area that we are going to be using. As per the examiner, we can see we are using 20 acre piece of land, and within the 20 acre piece of land, we know very well that we are going to be doing some apportionment for the costs. So in this scenario, for example, you are able to incur a cost of purchasing a land, which is around 6 million each. That is equivalent to 600 million. But we did not utilize the full of it. So when we are going to be doing our question, we have to be basing our argument on 20 acre piece of land. Now, let us start by start our question here. Let us start our question here. And the question will be reading. So the question here, we have already written our title. We have already written our title here. And then after you have written your title, you know very well that after the title, you need now to start with your additional information. Now, the first thing that I have to be checking on this question is that the costs, right? We have to be checking on the cost of purchase, or what were we able to sell.
That is, it means we have to be starting with sales. Now, when I look on the details given here by the examiner, I find that the cost of construction, all units were sold in bullet number 4. All the units were sold at a price of 1,600. How many units were we able to construct? The examiner has given us 240. So let us look on the sale of units. That is around, each unit was being sold at 1.6 million. So in my case, I talk about 1,600. Then I multiply by 240, right? 1,600 times 240. I'm getting 384,000. 384,000. Then we look on whether there is any other income that we generated, and we find we did not generate any other income. Then we less our allowable expenses. We less our allowable expenses, right? Then we start by the cost of purchasing a land. Cost of purchase of a land. Remember, each land was costing 6,000. Then we were able to use 20-acre piece of land. So this comes to 6,000 times 20. We get 120,000. Now we continue. Cost of surveying was 4.6. And remember, we were surveying a 100-acre piece of land. So we apportioned for 20 acres. So in this case, the cost of surveying, right? You remember you used for the figure given for 4.6 is for the whole 100 acre. So you apportion for the area that you used. So 4.6 million times 20, then you divide by 100, getting 920. From there, the cost of surveying, we have been told also there is a cost. We have been told that the cost of constructing each unit, the cost of surveying was 4.6 and conveyance fees. Conveyance fees, which was also amounted to 6960 times 20 over 100. So 0.2 times 6960. Here we are getting 1392. Now from the conveyance fees, we go to the cost of construction. So the cost of constructing each unit amounted to 1450. So I just take 1450. I multiply by all the units we constructed, where we are being told is 240. So 1450 times 240, 314,000. That is the cost we incurred. Now from there, we are being told all the units were sold. We have already worked on that. But we have been that the building materials for constructing each unit amounted to 742,000 inclusive of VAT at the rate of 16%. So building materials. Building materials. So amounted to 742.4 times. Remember, this figure is inclusive of VAT. So once you remove, then you are, because the figure is at 116, you ask yourself, what about 100, right? So it will be, and remember the 747, how much was it? The cost of building each unit, then we multiply by 240. We multiply by 240, because this is the cost for one unit. And then we incur 742,400 for one unit. So what about 240? So it will be 742.4 times 100. You divide by 116 times 240. We are getting 153,600. 153,600. Then from there, we have been told that the professional fees paid to quality surveyors inclusive of VAT was 417.6. So here we are talking about professional fees. Professional fees. Now, professional fees was 417.6. Then you multiply by, was inclusive of VAT, 100 over 116, right? So 100 you divide by 116 times 417.6. And you are getting 360. 360. Then from there, we are also being told that the civil engineers was 243,000. So civil engineers, again, you do the same. So the civil engineers we are being told is 243.6 times 100 over 116 times 243.6. Here we are getting 210. That is for the civil engineering. Now, drainage system and sewer line cost 960,000 for connecting all units building to be built on 100 acres piece of land. So drainage system here. Since we used only 20 acres, so you say 20 over 100, then you multiply by, we used only 20 acres, so you multiply by 960, right? You multiply by 960. So 0.2 times 960, we are getting 192. You are getting 192, right? Then from the drainage system, we got the interest on loan to acquire the 100-acre piece of land was 7.8. The interest on loan we factor is for 20 acres. The interest on loan. So it will be 20 over 100 times 7.8. So it will be 20 divided by 100 times 7.8, which will get 1560. Now from there, we are being told that the higher purchase of bulldozers, we were able to hire bulldozers. Hire of bulldozers. So our bulldozers, we were able to hire them at a cost of 6,600, sorry. We multiply by for each. So we were to hire how many? We have been told 600 for each of 3 months used in the construction. So 600 you multiply by 3, you get 1,800. From there, we have the cost of approving, because we have been to the cost of constructing a site office, sorry. Charges paid to the government in respect to approval of plans, right? Approval of plans. Approval of plans amounted to approval of plans, we were being told is 678. 678, that is approval of plans. Now we have the site office and we have been told the cost of constructing a site office. Our site office was costing us amount to 800. Then we have been told that we have the costs of hiring a saloon car there. So we have been told the higher cost for saloon car manager amounted to 40,000. So saloon car. So it is 40,000 times 3. We are assuming that we have 3 months in site. On that side, sorry. So this is amounting to 120. That is 120. So 40 times 3 is 120. Now from there, we are going to be dealing with other incomes. And when I look on that additional information, where we are being told that commercial building was also constructed at a cost of 5.6 in a piece part of the land, but the building was rented at a monthly rent of 480. So we have other income business there we have to be dealing with. So let us look on the other incomes here generated. Let me fix it here. The other incomes, we have rental income. Rental income, which in this case it is gross. So we have been told is 480. So from May to December, I think those are equivalent to 8 months, right? So 480,000 times 8, we are getting 3840, right? 3840. Then because it's a commercial, you less IBD at the rate of 10%, right? So IBD at the rate of 10%. So it will be 10% times the cost of construction, which is 5.6, times 8 over 12. Times 8 over 12. Because once you construct that IBD, it will be for the whole year. Then you apportion for the 8 months we have been in operation. So 0.1 times 5,600 times, right? 0.1 times 5,600 Then you multiply by 8, you divide by 12, getting 373. Then you subtract there. Now, in this case, let me just put it at the far end, 3840. 3840 there. So let me first look on the allowable expenses. Let me add all of them. We have 120,000 plus 920 plus 1392 plus 348,000 plus 153,600 plus 360 plus 210 plus 192, right? Plus 1560 plus 1800 plus 678 plus 800 plus 120. This one you are getting 629, 632. So how much are we subtracting there? So we take 384,000 minus my answer, and we are getting a loss. We are getting a taxable adjusted business loss, or taxable loss of how much? 245, 632. That is what we are getting. But when we want to determine the taxable income, we say this one will be carrying it forward for the next years. And we know very well that a tax from another source of income cannot be used to offset another income from another source. So that loss cannot be offset by the rental income. So in this case, to determine how much the total taxable income, just factor the income for rent. So we talk about the total taxable income. The total taxable income, I just take 3840 minus 373, and I'm getting that 467. This is what qualifies to be taxed. Not only we take this minus all the income we have generated, because we have said the income from another source cannot be used to offset a loss from another source. Now, to calculate the tax liability here, I will take 30% of 3467, right? 0.3 times 3467, getting 1040. Then you less the withholding relief for rent. And in this case, it will be, the rate is 10%. You multiply by the gross amount, 3840. This is 384. Then our tax payable. Tax payable will be how much? 1040.1 minus 384. We are getting 656.1. 656.1. 656.1. Now, I just want us to do another question for construction, if there is no any question. Another question there for construction. The question was tested on let me check here. November 2019, question 4. November 2019, question 4. So Tabitha, you can read for us. Someone to read for us, please.
Okay, we read.
Go on.
Benita Contractors Limited operates in the construction industry. On 1st November 2016, the company won a tender for the construction of 2 projects, a hospital and an office complex. Construction of the projects commenced on 1st January 2017. The following details relate to the 2 projects for the year ended at 1st December 2018. We have the hospital project and office complex. The balance as at 1st January 2018, we have materials, accrued salaries and wages. We have a planned written down value, have cost of work done, value of work certified to date. Transaction undertaken during the year were material delivered to site, from store, we have from supplier, plant purchased at cost, subcontractors fee, consultants fee, inspection fee, salaries and wages, head office expenses, material transferred out, material sales, plant lease charges, direct expenses, cash received from subcontractor, cumulative value of work certified. As at 1st December 2018, we have value of work uncertified in the year. Balance carried forward, material on site, and accrued wages. Additional information. Consultants fee for the hospital project include 40,000 prepaid for the year 2019. Wear and tear allowance on plant was provided at the rate of 12.5% per annum. Director expenses accrued and not reflected above were as follows. For the hospital and for the office, as at 1st January 2018, we have for the hospital 200 and 0 for the office. As at 1st December 2018, for the hospital was 1,000 and office 400 required. A schedule showing the taxable profit and tax payable, if any, by Benita Contractors Limited as at 1st December 2018.
Thank you so much. When you look on the question, is differently from the setup of the question, different from the one that we have done. And the question is bringing us to the concept where we talked about looking on the value of the work certified and also looking on the cost of the work certified during the year. And the only thing that we can be able to do here, we have to be looking, because to determine the total taxable income, you need to be looking on the value. When you talk about the value, it means those will be treated as our incomes. Then we subtract the costs so that you can be able to determine what is the total taxable income. Now, when you look on my board here, I have already separated the question on how it should be done. So for this instance, you can see I was able to group. I have not said that you're not going to be writing the headlines, the head, for instance. So it means the head, you have to be writing it, but I'm putting it in that manner because of my space. Now, in this case, I just need to be, to determine the value of the work certified during the year, I just need to be taking the breakdown, the cumulative value of the work certified at the end of the year, 2018. So I start with the cumulative value at the end of the year. Cumulative value is at 31st, 12th, 2018. So in this case, the examiner has already given us down there is 700,000 for the hospital, and the other one is 860. So let me reduce my shillings here to thousands. Now this one is given as 700. And then the other one is given as 860. Then we subtract the cumulative value at the beginning as at first 2018, right? So how much is it? The examiner has already given you the balance at the beginning. So the value of the work certified to date, where the question starts, is 200. The other one will be, on the other side of the office complex, it will be 160. So once you subtract, what I'm going to be getting, it is the value of work certified, and I will be able to denote it as A, right? So this one is 500, the other one is 700. Just like that, just like that. Now, let us subtract. What we are going to be deducting, or what we have to be looking next, is the total cost. And the total cost is per how the question is arranged. We are going to be starting with materials per the balance at the beginning of the year. So we start at the materials. At start. Material at the beginning of the year. The examiner has already given us 6,000. Those are the materials for the hospital. So I put them here, 6,000 there. Then the other side I've been given 400. 4,000 there, materials at the start. Then I look on the any other transaction related to material. I can see material which were delivered for to the site. So it means there was additional materials, material to the site. So we have to be checking the materials given here. So we are being told there is a material from store. Material from store, we are being given how much? 10,000. Right, it should be 10. Should be 10, really? No. So it means here, 6,000. We have 10. It should be 6,010, yes, 10,000. It should be 10,000 here. Right. Then it means all these figures of mine should be in thousands. Right. They should be looking like that. So material from store, we are being given 10,000. The other one is 14,000. Now, material, because these are additions, it means that the material at the beginning are increasing. Now, the other one is from supplier. Material from the supplier, we are being given 100,000. The other side, we are being given 128,000. Right? Now, from there, we proceed to, do we have any other materials? Yes, we have been told there is a material transferred out. Material transferred out, it means we are supposed to be deducting. So how much are we subtracting? The material which were transferred out. One side we can see we have 10,000. The other one we have 17,000. 17,000 there. Then we have material sales. Then it means we also reduced our materials. So material sales we have. Material sales we have. Here we have dash. Here we have 22,000. There we have 22,000. I think we also have the material brought down or carried down, sorry. Material at the end. Down there. The material at the end, we are being given 40,000. And then we have 50,000 here. So 40,000. On the other side, we have 50,000. So how much do we have material used during the year? So I take 6,000 plus 10,000 plus 100,000 minus 10,000 minus 40,000. I'm getting 66,000. I put them here. On the other side, we have 40,000 or 4,000, sorry, plus 14,000 plus 128,000 minus 17,000 minus 22,000 minus 50,000, and I'm getting 57,000. 57,000 here. So let us proceed with the other information. When I look on my balance sheet at the start, I can see we have salaries and wages. So salaries and wages, you normally look on the terms used. I can see the examiner is talking about accrued salaries and wages. So I have to be checking on the salary that we paid during the year. So I can see we have salary somewhere on the transaction undertaken during the year. We have some salaries. Let me check. Salaries and wages that we pay during the year. We start with 120,000. We subtract the accruals at the beginning. So at the beginning, we had issues of 1,500. So already we saw them. So let me write it here. 1,200 minus 15, right? Is it 1,200? No. This is 120,000 minus 1,500. Then you add salaries and wages at the end, which is 1,000. So how much is this? So 120,000 minus the accrual at the beginning, which is 1,500 plus 1,000 at the end. You get 119,500. You do the same on the other side. So we are being told the salaries and wages was 180,000 minus the balance sheet at the beginning for accrued salaries was around 1,200. So we subtract 1,200 plus the salaries at the end, which was 2,000, which were 2,000 now. So here we get 180,800. 180,800. Those are our salaries and wages. Now from there, we go to the plan, and you know the plan in this scenario, we can only grant it WTA. So in this case, let us do the WTA for that plant. On the side of the hospital, we did not add any other plant. So the rate is 10% for WTA for that plant. So it is 10% of that plant, 10% of the cost. So I can see at the beginning for hospital, we had 190,000. But we did not add anything during the year because there's the information provided there for the purchase of the plant. On the hospital complex, we did not purchase anything. So this translates to how much? Right, 19,000 here. On the other side, it will be 10%. We multiply by, during the year, I can see, so okay, the balance at the beginning is 150,000. Plus, during the year, we were able to purchase plants, some plants amounting to 120,000. Right? So the total cost of the plant that we have is 17,000 times 0.1. This is 27,000. That is 27,000. Now from there, we proceed to after the plant. I can see we have the cost of work done, which is we are going to be factoring later. And then we have the value of the work certified during the date or during certified to date, we are big given there. And we shall be able to work on it later. Now, when we go to the transactions undertaken during the year, we start with the material delivered to site. We have already worked on that. So from the supplier, all the plans and so on. So we go straight away to subcontractors fee. Subcontractor's fee given here. The examiner has already given us one side does not have, but the other side has 18,000. The other side has 18,000. Now, from there, we go to, after the subcontractor's fee, we have consultancy fees. And there is an additional information for this. So the consultancy fees, we have been told in additional information number one, that there was a 40,000 which was a prepaid. So we subtract the prepayment. So during the year, we were able to pay 30,000 here. But we subtract 40, right? 40, which was a prepayment. Prepayment is not an expense because it is yet to be incurred. So this translates to 29,960. On the other side, we have been told the consultancy fees amounted to 29,000. It comes to 29,000. Now let us move on to inspection fees. Inspection fees. So inspection fee given, here we have 10,000. On the other side, right? On the other side, we have 5,000. The other side, we have 5,000. Those are the inspection fees. Now, when you move to salaries and wages, I think we have calculated. We have the head office expenses. Head office expenses. So the head office expense given here, we have been given 2,000 for the side of complex. After the head office expenses, you can see we have the material transferred out and sales. We have already worked on that. Then we have plant district charges. Plant list charges. So under the plant list charges, we are being given 400 and 500. 400 and 500 here. Right? 400 and 500. Then we have direct expenses. Direct expenses. Direct expenses which have certain information under the additional information. So during the year, you can see the direct expenses you paid 3,000 at the beginning because we are being told the accrual. So it means I just need to take 3,000 minus the accrual at the beginning, 200 plus 1,000, right? This comes to 3,800. 3,800. Then the other side, we have 2,400 because we are taking direct expenses for 2,000. At the beginning, we don't have minus 0 plus 400. This comes to 2,400. 2,400 there. 2,400. So in that scenario, what I need to get is the total costs. Total cost there. So what is our total cost here? So in this case, we have 66,000 plus 119,500 plus 19,000 plus 29,960 plus 10,000 plus 400 plus 3,800. We are getting to 48,660. On the other side, I'm getting how much? 57,000 plus 180,800 plus 27,000 plus 18,000 plus 29,000 plus 5,000 plus 2,000, that is 2,500 plus 2,400. Getting 321,700. 321,700. So the question does not end there. So we have to be looking on some working there to determine the cost of work certified. So let me rub the upper part. The upper part here. I just rub here. Let me do my workings here, inside here. So we need to do some workings there. And just want to do some workings. So we need to say, to get the total value, you just need to take the value of work certified. The value of the work certified plus the value of work uncertified. The value of work certified plus the value of work uncertified. Now let's start with hospital. Now to get for hospital, we just need to be looking on the value of the work certified, which was 500,000. Then the value of unwork certified is given in the question, and the examiner was able to give us 30,000. So the total is 530,000. We have office complex, which should be equal to, right? The value here is 700,000 plus the value given there, it is 42,000. This is 742,000. Now, in this case, 742,000 in this case, let us look on the cost of work certified. The cost of work certified. So I'm going to be starting with hospital. We start with hospital there. And for hospital, to get the cost of work certified, take the value of the work certified, 500,000. You divide by the total value for hospital, 530. Then you multiply by the total cost for the hospital, 248,660. 248,660. So how much is this? 500,000 divided by 530,000. Then we multiply by 248,660. You are getting 234,585. Now for complex, we just need to be taking 700,000. You divide by the total value, 742,000. We multiply by the total costs, 321,700. So it will be 700,000. You divide by 742,000. Then you multiply by 321,700. Then you are getting 303,491. Now, because I know in your book you have a very long space, so once you finish calculating this, because this is outside, I continue with my question and I say, this is the costs, right? This is the cost of work certified. Which is denoted our B. So this case, it will be 234, 585. That is your B. Then the other side will be 303,491. So to get the total, to get the value, right? To get the, what are we getting there? To get the taxable income, I just take A minus B. A minus B. Remember your A is here and B is here. So how much is the total taxable income? 500,000 minus 234,585. You're getting 265,415. The other side will be 700,000 minus 303,491. Getting 396,509. 396,509. 396,509. Any question? Any question? Any questions so far? That is how you normally do taxation of construction businesses. So I think you don't have any problem on that. We can proceed to so next time we can do double taxation treaties and tax planning together with SACCOs, those are short, SACCOs, golf clubs, and so on. We are going to be looking also the taxation of air transport. How is it normally taxed? And then later on, we do tax investigation. I think we shall be moving in the right direction. But let us do our revisions. Let us do our revisions as we move on, because we have a lot to cover. But we shall arrange ourselves. I think I will not be missing any class moving forward. I'm expecting to finish in the next 2 Sundays. We shall finish our class. We shall finish our syllabus. Thank you.